Good afternoon, everybody. My name is Ryan Belanger. I'm the Managing Principal of Claro Advisors. Thanks for joining us for what we hope will be a very impactful 1 hour of information on Social Security, a very interesting topic, a lot of nuances here. This is our 7th or 8th iteration of this seminar. Now it's a webinar to make it a little bit more convenient for you folks, but we find feedback is very good, and you always get your questions answered, which is most important. So with us today, we have the former Regional Communications Director for Social Security, Kurt Czarnowski. He now runs his own firm, Czarnowski Consulting, locally here in the greater Boston area. Kurt was with Social Security for almost 35 years, and he's well known and regarded here in this area as the expert on Social Security. And like I mentioned, he will always answer your questions, and very thoroughly, and it's a huge value for our clients. So we've got a lot of people joining us on this. There is an ability to ask questions. If you can't figure that out, feel free to email your advisor. He'll make sure your questions get answered timely. So with that, I'm going to introduce Kurt Czarnowski here, and he's going to get into his presentation. And you'll be able to ask your questions, and those will get answered at the end of the presentation. So thank you for joining us, and without further ado, there's Kurt Czarnowski. Thank you.
Thanks, Ryan. Good afternoon, everyone. Good to be back. Yeah, Kurt Czarnowski, currently the principal in Czarnowski Consulting, as I always like to say. Those one or two in the webinar are not familiar with us. We're an international consulting firm whose world headquarters are conveniently located in the basement of my house in Norfolk, Massachusetts. Don't worry, it's Czarnowski Consulting. Our tagline is we provide expert answers to your Social Security questions. And when I say that, well, simple, as Ryan referenced, I worked for the Social Security Administration for 34 years. The last 20 years of my career, my job was as the communications director here in New England, which meant I spent my time out talking to folks about the program. And now in my retirement, well, such as it is anyway, I'm now in my 9th year of continuing to do that same type of work, largely because I enjoy the heck out of it, but also because I believe there's a real need for the information. Believe it or not, the Social Security program is now a little over 84 years old. And each and every month, the Social Security Administration pays about $77 billion in benefits, around 63 million people. And on top of that, there's another 177 million folks, like most of you on the webinar, who are now out there working and paying into the program. And what I saw during my time with the agency, and now that I'm out on my own, is despite the age of the program, despite the size of the program, and despite the economic impact that Social Security has in this country today, unfortunately, the myths and misunderstandings that are out there about what it is, as well as what it isn't, are frankly staggering. Nobody knows nothing about the program. So I was excited to again come back and work with Claro and clients and prospects, try and help you better understand what the Social Security program is, recognize what it isn't, dispel some of those myths and misunderstandings that are out there, and help take you down the road to the comfortable retirement we all hope to enjoy. So, most important slide in the presentation is this one, which I can't get up. Try. Technical difficulties there. Oh, there we go. Most important slide in the presentation is this one. You hear me reference it over and over again. People need to understand when Social Security was created a little over 84 years ago. The program was put in place to provide folks with a base or foundation of income that they can definitely count on being there for them, but it's a base of income protection that people
Sorry to interrupt. We are having a technical problem with the One second, everybody. I think it worked. Okay. All right, we're back. I'm not sure. There you go.
Alrighty. Thank you. Good. People need to understand the Social Security program was created to provide you with a base or a foundation of income that you can count on being there for you. But it's a base of income protection you must take steps to supplement. The program was never intended to be anyone's sole source of income in retirement. But unfortunately, these days, about 22% of retiree couple households, the Social Security money that comes into them each month is virtually the only income they have. Now, it's a terrible situation. So how avoid that happening to you? Well, simple, by planning for retirement, obviously. And you'd be commended, taking time out of your busy day, spend a little time planning for retirement and learning about the Social Security program. Now, for the longest time, the Social Security Administration had tried to play a proactive role in helping you plan for your retirement. Because back in the day, they used to mail to anyone who was 25 years of age or older a paper Social Security statement. That planning document designed to show up in somebody's mailbox about 3 months before the birthday, providing someone with important retirement planning information. A Social Security statement would provide benefit estimates at 3 ages, 62, your full retirement age, or 70. We'll talk in a second why those are important ages. But the other thing, the statement that was so important, it provided you a nice year-by-year breakout of what the Social Security Administration had recorded as your work and earnings under the program. We'll see in a little bit what you collect each month is directly related to what your work and earnings have been. So it was important to verify that the earnings information Social Security had for you was accurate, because if it wasn't, it would have a direct impact on what you eventually received. So it's important to take a look at that statement each year, make sure the earnings information correctly recorded, and if a mistake occurred, it was important to catch it and correct it, because as I said, it didn't have a direct impact on what you eventually would receive. But you may have noticed, I haven't gotten those every year lately. What's the deal? Well, Social Security has significantly altered their distribution plans for Social Security statements. And they no longer mail paper documents on an annual basis to everyone 25 years of age or older. Instead, what they've done first and foremost is put in place a system whereby if you go to socialsecurity.gov/myaccount and take about 10 or 15 minutes or so to set up your individual Social Security account, an important byproduct of having that account in place is you'll be able to download through a secure website a Social Security statement for yourself whenever you need or want one. You're going to spend some time with your Claro advisor doing some retirement planning. Having that account in place enables you to have in hand a current Social Security statement for yourself, which is going to make it a more worthwhile planning exercise. I encourage you to set up your account if you haven't done it yet. Social Security has also announced they resumed billing your documents, albeit on a very limited basis. And current distribution plans are that if you are 60 years of age or older and you haven't set up your account yet, they are going to still mail you a paper document, same old schedule, about 3 months before your birthday. That's it for mailings. Anyone under the age of 60, the only way you get a Social Security statement is by setting up your individual Social Security account. But in my view, even if you're over the age of 60, I think it makes sense to set up your individual account. Because again, you're going to meet with your Claro advisor, do some retirement planning. Having that account in place will enable you to have a current Social Security statement in hand, which is going to make that a more worthwhile exercise. So plan for retirement, take advantage of the Social Security statement, hopefully reinforce the message the program is going to get you this base, this foundation, but never intended to be your only source of income in retirement. The sooner you recognize that, work with your advisor to find ways you can supplement Social Security, the more likely you are to have that comfortable retirement. So as I travel around the country these days and talk to folks about retirement and Social Security, the most frequently asked question has to be, well, when should I take my money? So understand this, under the rules of the program, you've got choices and you've got options. What I'm trying to do this afternoon is make sure you fully understand what those choices and options are. In other words, I want to make sure you fully understand what you can do under the program. But ultimately deciding what you should do, that's entirely your choice, entirely your decision. After all, you're the ones who worked and paid into the Social Security program. I can't tell you what you should do, but my view is, unless and until you fully understand what you can do, you're in no position to decide what you should do. So make sure you fully understand the choices and options that are available to you, so that in the end you can be making an informed decision on when to start collecting payments. And what to start at is by making sure you know what Social Security calls your full retirement age, key concept in the program. Now, when Social Security started back in 1835, Congress set full retirement age as the month you turned age 65. It was age 65 for everyone without exception. And it continued that way until 1983, when Congress changed the law and increased Social Security full retirement age for anyone born in 1938 or later. Now, increase has gradually been phased in over time, so we're at the point where for a big chunk of the baby boomers, anyone born between 1943 and 1954, Social Security full retirement age is the month you turn age 66. But it's important to note that full retirement age continues to increase beyond that, and tops out under current law that anyone born 1960 or later has a Social Security full retirement age at the month you reach age 67. Now understand this, collecting at your full retirement age month, it isn't your only choice, it isn't your only option. But make sure you know what your full retirement age is. You'll see as we go through the discussion today, a lot of features of the program do flow from at least having reached your full retirement age. So make sure you know what yours is. But in terms of collecting payments, you have to start the month you reach your full retirement age. That means one thing and one thing only. It means you'll get 100% of the amount your work and earnings entitled you to receive. We'll talk in a second how that all gets calculated. That's what starting at full retirement age means. You get 100% of your benefit. But among the options you have are to start collecting prior to reaching full retirement age, if that makes sense for you. Now, under the rules, age 62 is the earliest point at which you can start to collect Social Security retirement benefits. But here's the thing, Social Security, as the name implies, is a social insurance program. Congress has built certain social goals into it. And one is a hope that at the end of the day, everyone ends up with roughly the same amount of lifetime benefits, regardless of when they start to collect them. And so under the rules of the program, you have to start taking payments prior to reaching your full retirement age. Well, by starting earlier, in theory then, you'll now be collecting for a longer period of time. You'll find that your monthly payment amount gets reduced. How much a reduction? Well, it's roughly 0.5% per month for each month prior to your full retirement age. You opt to collect Social Security retirement benefits. 0.5% per month, roughly a 6% per year reduction by waiting, but you don't have to start right on your birthday. You don't have to start the first of the calendar year, but you just need to recognize you have to start collecting benefits prior to reaching your full retirement age month. Your benefit is going to be reduced by roughly 0.5% for however many months you opt to collect. And oh yeah, it's a permanent reduction. None of those myths that are out there, folks think, hey, I'll start early, I'll get a lower amount, but as soon as I hit my full retirement age, my payment will zoom back up. Permanent reduction. Again, idea being starting earlier means, in theory anyway, based on average life expectancy, you'll be collecting for a longer period of time. You're going to be given less on an individual monthly basis. Now, as I mentioned, you start right at your full retirement age. That's when you get 100% of the benefit you're entitled to collect. But among the other options you have are to wait past full retirement age before starting to collect, if that makes sense for you. And with that social insurance idea in place then, if you've opted to defer past full retirement age, well then by starting later, in theory anyway, you'll be collecting for a shorter period of time. So by all rights, your monthly payment amount ought to be increased if you wait. And it is. These are referred to as delayed retirement credits. And for each month past your full retirement age, you opt not to collect, you'll find your benefit amount has now been increased by 0.2%. Now, 0.2% per month increase, that translates into an 8% per year increase by waiting. But again, you don't have to not collect for a full year. For each month past your full retirement age, you defer, your benefit permanently increased by that 0.2%. But here's the key thing. Delayed retirement credits only accrue from your full retirement age month until you turn age 70. You understand that's one of the rules of the program. You never have to take Social Security retirement benefits. Not like there's a required minimum distribution like there is with 401ks or IRAs or things like that. But if you opt to defer from full retirement age until age 70, you find your payment amount increase by 2/3% for however many months you haven't collected. You opt to defer past age 70, you can certainly do that, but you'll see no additional increase in your payment by waiting. So I'm going to give you a couple of examples to illustrate what I'm talking about. First example, we've got somebody with a full retirement age of 66. Let's say at her full retirement age of 66, she'd get $1,000 a month. What are her options? What are her choices? Well, let's say she wants to start collecting right at that earliest point, right at age 62. Well, the way the reduction factor works out, she receives 75% of her full retirement age amount. In other words, starting at age 62 and then $1,000 a month. No, she gets $750 per month and continuing. Well, yeah, she's getting $250 less each month that she received if she waited. The trade-off, obviously, receives that lower amount sooner, and in theory anyway, collects it now for a longer period of time. Say she wants to wait one more year, start at age 63, or benefit at that point, $800 a month and continuing. At her full retirement age of 66, that's when she gets the $1,000 a month her work and earnings entitled to receive. But say she wants to wait past that point because that makes sense for her. Well, wants to wait 1 year, start at age 67. Meaning at that point, benefit will be 8% higher, meaning her benefit going forward is going to be not $1,000 a month, $1,080 per month and continuing. She waits all the way until age 70, accrues the maximum of 4 years of delayed retirement credits, means her payment at that point is going to be 32% higher than her full retirement age amount. She'll have seen an 8% increase for each of the 4 years that she's waited, and it's simple, that's not compounded. But it means her payment starting at age 70, not $1,000 a month. No, it's $1,320 per month and continuing. Let's say she wants to wait to start at age 72. Still going to be that same $1,320, right? Because there are no additional delayed retirement credits past age 70. But here's another example. Now we've got somebody who was born 1960 or later. So this person's full retirement age is 67. And let's assume at full retirement age of 67, this person would get that same $1,000 a month. What are the options? Well, under the rules, even if your full retirement age is 67, you still have the option of collecting as early as age 62 if you choose to do so. But if you think about it, with a full retirement age of 67, you have to start collecting at 62. Now you're going to be receiving payments for a full 5 years prior to your full retirement age. So you'll find that your payment amount has been reduced even more. With a full retirement age of 67, you start at age 62, you get 70% of your full retirement age amount. So in our example, full retirement age amount $1,000, starting at age 62, you get $700 per month and continuing. Start at full retirement age of 67, that's when they get the $1,000, their work and earnings entitled to receive. But then they want to wait until age 70 before collecting. So the important thing, as I mentioned, delayed retirement credits accrue from your full retirement age until age 70. And so if you've got a full retirement age of 67, that's now only a 3-year period of time between full retirement age and age 70. So in this case, your benefit will be increased by that same 2/3% per month, 8% per year. But now you wait all the way until age 70, you'll see only a 24% increase in your payment over your full retirement age amount, an 8% increase still, but now it's only 3 years between full retirement age and age 70. So another issue, why it's very important to know what your full retirement age is. But the bottom line in all of this, as I said before, it's your choice, your decision. I just want to make sure you understand the fundamental concept. And what are the things you ought to be thinking about in deciding when to start collecting? Well, the obvious ones, your health, longevity for a second factor. I always ask people, do you come from a family of long livers, or do you come from a family of short pancreases? It's a line out of the movie Goodbye Columbus from 40-something years ago. Do you need the money? You're going to keep working. All those factors come into play. The whole idea was just an average life expectancy wasn't really supposed to matter. And regardless of when you started to collect, at the end of the day, you'd end up with the same total amount of payments. Life expectancy is increasing. Social Security numbers say today's 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 age 95. 65-year-old man today, on average, you're going to live to age 84. 65-year-old woman, on average, you're going to live to age 86. So for baby boomers and those who come after us, it's important to note that retirement for us could be a period of 20, 25, or maybe even 30 or more years in length. And my personal view tends to be for most of the boomers, as we head into retirement these days, if we have any type of pension at all, far more likely to be the defined contribution type, 401k, 403b, 457. We're walking out the door, not with a guaranteed stream of income like that traditional defined benefit pension. No, we're walking out the door instead with a pile of money. It seems like later in retirement, that pile of money will have diminished somewhat. Later in retirement, healthcare costs will likely be higher. So you may have a greater need for a higher monthly income later in retirement than when you make that initial transition. And one way you can help meet that need is by delaying the start of your Social Security benefits. Again, it's not for me to say, it's your choice, your decision. As I said right up front, I want you to be making an informed decision. I want you to understand the basic concept, which is you start sooner, you get a lower benefit amount each month for the rest of your life. You wait longer before you start, you get a higher payment amount each month for the rest of your life. But back in the day, when Congress set that reduction rate and increase rate based on average life expectancy at the time, it was all supposed to come out about even. But these days, life expectancy is increasing, and things come to those who wait. But again, it's not for me to say, your choice, your decision, and I want you to understand that fundamental concept. Oh, the second area I would get questions about is, well, how do they figure out how much I'm getting anyway? So understand this, as I said a while ago, there is a relationship between your work and your earnings and what you collect each month. We'll see in a second, it's not a perfect correlation. But in calculating benefit payment, Social Security simply uses a formula that Congress has written right into the Social Security Act. Now, the formula has a number of different steps in it. First step, Social Security does go back and adjust all of your prior year earnings for inflation, bring them up to what they are in today's dollars. But then once they've done that, they calculate your benefit by plucking out and averaging your highest, wait for it, 35 years of work under the system. Another of those myths and misunderstandings on how many folks mistakenly think their benefits based on their high 3 or their last 5, like some other pension systems. Social Security benefits based on a lifetime of earnings, which these days defined as your highest, an average of your highest 35 years of inflation-adjusted income under the Social Security program. So what happens if you don't happen to have 35 years and you've actually contributed to Social Security? You've taken time out of the workforce to raise kids, care for aging parents, or perhaps work for a while in a job where you weren't paying into the Social Security program. Unfortunately, no provision for that. This is an average of your 35 highest years of work under the system. And if you don't happen to have 35 years of something, zeros get added into those additional years, it lowers your average monthly benefit, it lowers your average monthly wage, and lowers your Social Security benefit. But here's an important takeaway for today. It's another example of Social Security being that social insurance program. And putting that formula in place, Congress has recognized that people in lower paying jobs less likely to have a pension of any type, less likely to be able to save for retirement during their working years, they need the money for food, clothing, and shelter. So the system is set up to try and help people who've been in lower paying jobs, providing a monthly payment amount which is intended to replace a higher percentage of that person's pre-retirement income, somewhere in the neighborhood of 55% replacement rate. Now, for someone who's been a higher earner throughout his or her working lifetime, by all means, they get more each month in absolute terms than that low earner does. But if you look at what the payment represents, it's actually designed to replace a smaller percentage of that person's pre-retirement income, somewhere in the order of 34%. And for the average worker these days, the Social Security benefit only intended to replace around 41% than what someone's making at the time they retire. In no case, high earner, low earner, average earner, is it intended to replace 100% of what you're making when you retire, which leads us back to that first slide I showed you. You got to recognize the program intended to provide simply a base or a foundation of income that can be counted on being there for you, but it's a base of income protection you must accept to supplement because it was never intended to be your sole source of income in retirement. The sooner you recognize that, work with a Claro advisor, the more likely you are to have that comfortable retirement. All the numbers you can think about this afternoon. 2019, the average Social Security retirement benefit being paid is $1,461 a month. $1,461 per month, average Social Security retirement benefit, around $16,000 a year. But I often get asked, well, is there a maximum payment that Social Security makes? Well, we'll qualify the answer by saying in 2019, someone who is at his or her full retirement age of 66 this year, and who for each of the past 35 years has had earnings at or above whatever the taxable maximum level of earnings has been for each one of those years. That's an important point. Each year there's a maximum level of earnings upon which Social Security tax is imposed. 2019, for example, you can get $500,000, but this year you only pay Social Security tax on the first $132,900 that you make. Anything you make above that, sure, you pay federal income tax on, you pay a Medicare tax on, but you don't pay that 6.2% Social Security payroll tax. So when it comes time to average someone's earnings to calculate your benefit, this year Social Security won't average in the $500,000 total. No, they'll only average in that $132,900, the earnings that have been subject to Social Security tax. So to recap, 2019, somebody at full retirement age of 66 this year, who for each of the past 35 years has had earnings at or above whatever the taxable maximum has been for each of those 35 years, this year he or she receives $2,861 a month. $2,861 or around $35,000 a year. Nothing to sneeze at, but you got to remember it's designed to be a base or a foundation, and you got to find ways to supplement. So let's talk next about working in retirement. A lot of people have questions about this, and this is another area where it's vitally important to know what your full retirement age is. Because under the rules of the program, if you're looking to collect benefit payments prior to reaching your full retirement age, but intending to work at the same time, you need to understand that you're limited in how much you can earn before it begins to impact your ability to collect. 2019, under your full retirement age, you're allowed to make up to $17,640 without any loss of benefit payments whatsoever. $17,640 or less, you'll collect full benefit payments every month of the year. Now, you make over that, doesn't mean you can't necessarily collect at all, but Social Security then is required to start holding back $1 in benefits for each $2 that you're over that threshold. So, depending upon how much you're making, you may not be able to collect even if you want to. So what counts towards that $17,640? Two things only: wages and or net income from self-employment. In other words, earned income only. That whole wide world of unearned income you might be receiving, a VA benefit, a General Motors pension, bank interest, dividend, 401k distribution, rents, none of that counts towards that $17,640 threshold. Earned income only. But the good news is, from the month you reach your full retirement age on, there's no longer any earnings limitation imposed on you whatsoever. From full retirement age on, you can work and earn as much as you like and collect full Social Security benefit payments at the same time. But occasionally I'll get asked, hey, I'm retired and I'm thinking about going back to work. I don't have to pay Social Security tax on my earnings, do I? Well, if you're in a job covered by Social Security, you will certainly pay Social Security tax on those earnings, even if you consider yourself retired. And that's good news for the folks at Social Security because they can use the money. But that's potentially good news for you as well. As I mentioned, your benefit's always calculated by averaging your 35 highest years of work under the system, regardless of when they occur. It isn't necessarily your first 35. It isn't necessarily your last 35. It isn't even necessarily 35 consecutive years. So even if you're retired, you go back to work. You pay into the Social Security program. At the end of the year, you file your tax return. Social Security will automatically do a match and compare that new year of earnings with the lowest of the 35 years that it's using to calculate your benefit. And if that new year of earnings is higher than the lowest of the 35 years they'd had been using, well, they will recompute your benefit. They'll drop out that low year, plug in that new year, results in a benefit increase for you going forward. And this ability to increase your payment through additional work and earnings, it continues forever. Yeah, delayed retirement credits that bump in your payment because you haven't collected, those stop at age 70. No additional bump past age 70 by not collecting. But no matter how old you are, if you're working, paying into the program, and the earnings that you have are higher than the lowest of the 35 years that Social Security had been averaging to calculate your benefit, well, the good news is your payment will be recomputed, your benefit will increase, again, no matter how old you are while working. The other bit of good news about working, frankly, is it never hurts. So you've been a high-priced executive, but in retirement, take a part-time job at the local golf course, driving the beer cart around. You make a couple $1,000s. At the end of the year, that couple $1,000 probably going to be lower than the lowest of your 35 years. So what happens to your benefit amount going forward? Nothing. Stays the same because it's always based on an average of your 35 highest years of inflation-adjusted work, regardless of when they occur. So I said a while ago, I think good things come to those who wait, and I think good things come to those who work as well. Because as long as you're working and paying into the system, there's always the possibility your benefit's going to be increased, and it's never going to be decreased. So let's move on and talk about spousal benefits and survivor benefits. And I'll bring you up to date on a Social Security claiming strategy that had been all the rage for a number of years, but is about to go bye-bye. Let's talk about spousal benefits first. Social Security spousal benefit program been around about 70 years or so, put in place by Congress largely to support the economic model of the American family of the 1950s and the 1960s. And so whenever I talk about spousal benefits, I illustrate it by referring to what in my baby boomer estimation was the prototypical American family of the 50s and 60s, which was the Cleaver family from the TV show Cleaver. Because in the Cleaver household, like every other family of the sitcom world of those days, you had Ward and June. Ward Cleaver, he was the only one who worked. He was the breadwinner. Ward Cleaver came downstairs each morning. He was impeccably dressed. He left the home briefcase in hand. Now we have no idea where he went or what he did, but he worked. And June Cleaver, prototypical American housewife of the 50s and 60s, well, she came downstairs each morning equally impeccably dressed. She had pearls and high heels on at 8 in the morning, for God's sakes. But June Cleaver never worked a day outside the home in her life. Her job was to have brownies and milk available for Wally and the Bee at the end of a hard day of school. Well, Social Security's spousal program supports the Cleaver economic model in the following way. Ward Cleaver, breadwinner. He'll get a benefit based on whatever that mysterious work was. So let's say at his full retirement age of 66, he gets $1,000 a month. June Cleaver, as his spouse, at her full retirement age, is going to be eligible to receive a payment equal to 50% of Ward's full retirement age amount, or in our example, $500 a month. That'll be paid to her in addition to the $1,000 that's paid to Ward, and it'll be paid to her even though she may not have worked a day outside the home in her life. Now, for June to collect as a spouse, the few conditions have to be met. First and foremost, Ward must be collecting his own retirement benefit. She can't be paid that spousal amount unless and until he is actually collecting. Second, for June to collect, just be at least age 62. Earliest age a spouse can collect, no different than on the retirement side. And if she's at her full retirement age when she claims benefits, that's when she'll receive the full 50% of this full retirement age amount. If she's younger than that when she starts, that 50% amount gets reduced. Someone's own benefit is reduced prior to full retirement age. And the third key factor is June's spousal payment is based on 50% of Ward's full retirement age amount. not necessarily 50% of what he may actually be collecting. So for example, Ward, full retirement age amount $1,000, but he's opted to wait until age 70 before collecting. So he's receiving $1,320 per month. At her full retirement age, June's still only going to get $500 a month, 50% of the full retirement age amount, not 50% of what Ward is actually collecting. So by the same token, say Ward had full retirement age of, that's okay, a full retirement age amount of $1,000, but he started collecting at age 62, so his own benefit was only $750 a month. At her full retirement age, June would still get $500 a month, 50% of the full retirement age amount. Now, that's the 50s and 60s though. Flash forward the 70s, 80s, beyond, because now in all likelihood, June Cleaver will have worked outside the home, will have worked and paid into the Social Security program. How does that all work together? So let's assume Ward still has his $1,000 benefit at full retirement age. Let's say June's earned a benefit on her own of $800 a month. They head off to Social Security together. Ward gets his $1,000, June gets her $800. Social Security is about to say goodbye and good luck, and June goes, hey, can't fool me. Where's my $500 spousal benefit? At that point, the Social Security goes, sorry, June. Under the rules of the program, as Ward's spouse, you can receive that 50% of his full retirement age amount, or your own, one amount or the other, whichever one is higher, but you don't get both benefit payments at once. Because in our example, June's $800 benefit exceeds 50% of Ward's full retirement age amount. That's what she collects. Now, say she hadn't worked that much, so her own benefit was $250 a month. Ward starts to collect. Well, at that point, she'd be given an additional $250 per month on top of her own benefit, moving from her own work entitled benefit to that 50% of his full retirement age amount. Spousal benefits. Incidentally, the program's absolutely, totally, completely gender neutral. What do we mean by that? Simple. Say the Cleavers had been ahead of their day, and back in the 50s, Ward was the stay-at-home dad, and June was the primary breadwinner of the family. Then everything I talked about would be equally true. That he could collect 50% of her full retirement age amount, or his own, one amount or the other, whichever one is higher, but not both at once. And I frequently get asked, does Social Security pay spousal benefits in the case of same-sex marriage? The answer is yes. Since June of 2013, prior to that point, Social Security was prohibited because of DOMA, the Defense of Marriage Act, which said for federal benefit purposes, marriage defined one man, one woman. But in the Windsor versus the United States Supreme Court case, that provision of DOMA was declared unconstitutional. So since June of 2013, Social Security will pay spousal benefits in the case of same-sex marriage. Again, assuming the marriage performed in a state that recognizes same-sex marriage. Spousal benefits, 50%. The higher earner's full retirement age amount or the individual's own, one amount or the other, whichever one is higher, not both at once. What about widows and widowers? What happens to June if Ward passes away? Well, for survivor benefits, it's actually better news for June, because as Ward's widow, she's going to be eligible to collect not 50% of his full retirement age amount, but 100% of the amount he was collecting at the time he passed away. Oh yeah, still, or her own, one amount or the other at a time, not both at once. So for example, Ward's getting $1,000, June's getting $800, Ward passes away. The good news for June is, at that point, assuming she's at her full retirement age or older, she'll immediately begin to receive an additional $200 a month, moving her from the $800 she'd been collecting on her own up to the $1,000 level that Ward had been collecting. Now that's the good news. The bad news, well, if you think about it, as I mentioned, she collects on one amount or the other, whichever one is higher. So while they were both alive, they were actually getting, in our example, $1,800 a month in Social Security payments. His $1,000 to her $8,000. He dies, so sure, her individual benefit goes up, but it's as if her old payment goes away. It's just something you need to plan for. You collect on one amount to the other at a time, you don't continue to get both benefits at once. The other point I want to make is this. Ward, full retirement age amount $1,000, but he's opted to wait until age 70 before starting to collect. So by the time he passes away, he's actually receiving $1,320 per month. Well, the better news for June is her own benefit increases from her $800 past $1,000 all the way up to that $1,320 that he'd been collecting at the time he passed away. So just keep in mind in deciding when to start to draw your own retirement benefit. Remember that by opting to wait, not only is your own benefit higher than it would be if you started earlier, but it also means that any survivor benefit that could be made upon your passing is going to be higher as well. By starting sooner, your own benefit's lower than it would be if you waited. It also means any survivor benefit going to be lower than it would be if you waited as well. Another reason why I tend to say good things come to those who wait. But a couple other points about widows and widowers. They can actually start to collect a little bit sooner. Earliest age a survivor can collect is age 60. But same concept holds. You have to start collect that payment prior to reaching full retirement age, because now, again, starting sooner, in theory, you're collecting for a longer period of time. Again, you'll find that benefit amount reduced over what you'd receive if you waited until full retirement age. And you start right at age 60, you get 71.5% of the amount you'd receive if you waited till full retirement age. The third bullet is a key one. It's important to remind folks when talking about survivor benefits, yes, indeed, you collect on one account or the other at a time. You don't collect on both at once. But under the rules, it's possible to sequence the collection of benefits. So, for example, June Cleaver, widow at age 60, opt to collect a reduced survivor benefit, collect, and then at her full retirement age, file for and begin to receive a full unreduced retirement benefit. She wouldn't think you could get both at once, but she could collect a reduced amount on one account and then switch to the other at a later date. The reverse could be true too. She could, for example, at age 62, start to collect a reduced retirement benefit and then switch to her own full survivor benefit at full retirement age. Again, one or the other at a time. The important point is this. Whether you're collecting a retirement benefit, a spousal benefit, or a survivor benefit, if you're under your full retirement age and working, you're subject to that earnings limitation we talked about a few slides ago. So June Cleaver, widow at age 60, working, making $500,000 a year. Well, she's not going to be able to collect anything at that point as a widow, not because she's not old enough, not because Ward hasn't passed away. No, she's subject to that earnings limitation. But don't forget, at full retirement age, that earnings limitation goes away. So the strategy for June, she wants to keep working and is happy working. At her full retirement age, she can file for and begin to receive a full survivor benefit, be paid that even though she's continuing to work, and defer collecting her own retirement benefit, which would then accrue delayed retirement credits. And at age 70, then, she switches over and files for her own, and it will have increased because she hasn't taken it, even though she was collecting the survivor benefit at the same time. Now, the reverse could be true, but you defer collecting your own retirement benefit past full retirement age, you do accrue delayed retirement credits. Your benefit does grow by that 2/3% per month, 8% per year, right up until age 70. But there's no equivalent increase in survivor benefits. So the widow's benefit for June at her full retirement age, going to be the same as she'd receive at 68 or 69. No equivalent increase by waiting. So in cases like this, it generally makes more sense to take the survivor benefit first and defer collecting someone's own retirement benefit, because that's going to increase if you opt to defer past full retirement age, where with the survivor benefit, sure, you get less if you take it early, but you don't see any kind of increase by taking it late. But again, survivor benefits, 100% of what the deceased was collecting at the time he or she passed away, or would have been collecting had they started drawing benefits. So for example, Ward, full retirement age, 66, $1,000 a month. He intends to wait until age 70 before collecting, passes away at age 68, never having drawn a penny. The good news is June's widow's benefits based on what Ward would have been collecting had he started drawing benefits the month he passed away. So that 2 years worth of delayed retirement credits that he'd been accruing while he never personally benefited means that June's survivor payments will be 16% higher than his full retirement age amount, and she will get that. Again, another reason why good things come to most people. All right, so I want to spend a little bit of time just bringing you up to date on a Social Security claiming strategy that is about to be long gone and hard to find. Now, for about 15 or 20 years or so, there were a number of Social Security claiming strategies that couples had utilized as a way to optimize or maximize their lifetime Social Security benefits. One of those strategies, claim some now, claim more later. Well, hello.
Sorry, we're having a little bit of technical difficulties.
Claim some now, claim more later strategy. What was it all about? Well, we'll illustrate it with the Cleavers again. This is a situation where both Ward and June had worked, both had paid into the program. June Cleaver, full retirement age amount, $800. She's decided to collect. So she's over age 62, she's starting to collect. But Ward, having attended several Czarnowski consulting seminars, has decided that he wants to wait before claiming his own retirement benefit. He's wondering, June's collecting, is there something I can do to get me some money while I wait? And under this whole claim some now, claim more later strategy, it certainly was. That if Ward waited until his full retirement age, at that point, he had the option of, in essence, picking and choosing. He had the option of going to Social Security and asking to be paid just a spousal benefit without having to apply for his own retirement benefit first. Because he hadn't applied for his own retirement benefit, he'd begin to accrue delayed retirement credits, growing his benefit by that 2/3% per month, 8% per year, right up to age 70. But he could collect that spousal payment even while his own benefit was growing. The key thing was for Ward to be able to do this, he had to be at full retirement age or older. Because under the law, if you went to Social Security prior to reaching your full retirement age, you didn't have the option of picking and choosing, if you will. You were always deemed to be applying for both your own retirement benefit and spousal benefit at the same time, and you'd be paid on one or the other, whichever one were higher. But again, if you waited till full retirement age, you didn't have the option of deferring collection of your own and receiving just a spousal payment while your own grew. So this strategy significantly altered in November of 2015 with the passage of something called the Bipartisan Budget Bill of 2015. And under the terms of that law, it allowed basically for a phasing out of this claiming strategy. And so the new law says that if you were born January 1st, 1954 or earlier, then at your full retirement age of 66, if your spouse is collecting benefits, then you still have the option of taking just a spousal benefit and deferring collection of your own. One more time. If you were born January 1st, 1954 or earlier, then at your full retirement age of 66, if your spouse is collecting, then you still have the option of taking just the spousal benefit and deferring collection of your own. But born after January 1st, 1954, in terms of this claiming strategy, you are SOL, as they say in the vernacular, because under the new law, at whatever age you go to Social Security, you no longer have the option of picking and choosing. You're always deemed to be applying for both your own retirement benefit and a spousal payment at the same time. But just a quick reminder, as the last bullet points out, this pertains to spousal and divorced spousal benefits only. Nothing in this change impacts what I talked about a couple of slides ago about widows and widowers having the option of taking a reduced benefit on one account and switching to another at a later date. Survivor benefits, you still have the option of picking and choosing, if you will. This pertains only to spousal benefits. Just a quick reminder about taxation of benefits. Prior to 1983, Social Security benefits absolutely, totally, completely federal tax-free. That year, Congress changed the code, said if you were a higher income Social Security beneficiary, then you'd be required to pay federal income tax on a portion of the payments that you had received in the prior year. And how did Congress back in 1983 define higher income beneficiaries? Well, they said if you were a single tax filer and you had modified adjusted gross income, sometimes referred to as combined income, in excess of $25,000, or if you were a couple filing jointly, had modified adjusted gross income in excess of $32,000, then that first year you'd be required to pay federal income tax on 50% of the benefit payments that you had received in the prior year. What is modified adjusted gross income? Well, it consists of three things. It's your adjusted gross income. It's any tax-free interest you may have received in the prior year, plus 50% of your Social Security payments. You add those three things up, and if they fell below those thresholds, then no part of your Social Security benefits are subject to federal income tax. But those three things added up in excess of the thresholds, then again, starting in 1983 up to 50% would be treated as ordinary income tax at whatever marginal tax rate you're at. But what Congress didn't do was index those two thresholds. And now, if you have modified adjusted gross income in excess of 25 for an individual, 32 for a couple filing jointly, you could find yourself in a position of having to pay federal income tax on up to 85% of the payments that you would receive in the prior year. 15% always federal tax-free, up to 85% treated as ordinary income tax at whatever marginal tax rate you fall under. These days, about half of all Social Security beneficiaries do find themselves paying federal income tax on a portion of the payments that they had received in the prior year. At the end of the year, Social Security sends you a 1099 form. Use that in filing your tax return. Question often comes up, does Social Security automatically withhold a portion of my payments every month, set it off the IRS in advance like they do for my salary? The answer is no, they don't do it automatically. But if you'd like to have a portion of your benefits withheld in advance, perhaps avoid the need of having to file quarterly tax returns, then you can certainly ask to have that done, but it isn't done automatically by Social Security. So planning for retirement involves planning for the possible taxation of Social Security benefits. Now, what I've been talking about is federal taxation, because that applies no matter where you live. People often ask, well, what about state taxing of Social Security benefits? Well, it varies from state to state, but it's safe to say in the vast majority of states, 37 out of the 50 states, Social Security benefits are not subject to state taxation. That leaves 13 states where they are. So depending upon where you end up in retirement, may need to check, or probably will want to check with your state taxing authority to find out whether or not you're going to have to pay state income tax on a portion of your Social Security benefits. Quick reminder about filing applications for benefits. You have choices, you have options. The recommended way for me, file online, socialsecurity.gov. You can apply for benefits from the comfort and convenience of your own home. Now, in order to be able to apply online, you do need to have established one of those Social Security accounts for yourself that we talked about a few slides ago. So do that, but then you apply online, again, comfort and convenience of your own home. If you're not comfortable dealing online, you have some other options. You can call Social Security's 800 number, schedule a telephone appointment. Somebody will help you by completing the application over the phone, or you can also make an appointment to visit a local Social Security office. You've got choices and you've got options. Just a reminder about Social Security payments. Benefits are paid 1 month in arrears. So let's say, for example, you're going to retire June 30th, and you want to start collecting your Social Security retirement benefit effective this month of July. Your Social Security payment for July will be sent to you in August. Benefits go out 1 month in arrears. But the other thing to be aware of is this. Back in the day, Social Security used to pay everyone on the 3rd of the month. The payment that went out on the 3rd was the Social Security benefit for the month before. But starting about 20 years ago, recognizing with the onslaught of the baby boom generation, the number of people collecting was going to grow. So since 1997, Social Security has staggered benefit payments through the course of the month under the following system. If your date of birth is between the 1st and the 10th of the month, then your Social Security payment will be direct deposited into your account each month on the 2nd Wednesday of the month. If your birthday falls between the 11th and the 20th of the month in which you were born, your benefit will always be direct deposited into your account on the 3rd Wednesday of the month. And if your birth date falls between the 21st and the end of the month, your Social Security benefit always direct deposited into your bank account on the 4th Wednesday of the month. So just something to plan for. Your date of birth is the 25th of the month. You intend to retire from work June 30th. You intend to start collecting Social Security benefits effective the month of July. Just recognize you're not going to see your first Social Security retirement benefit until the 4th Wednesday of August. So just something you need to plan for, figure out how to tide yourself over. Because again, benefit payments 1 month in arrears, and payment dates staggered through the month based on someone's date of birth. So you need to plan for that aspect of retirement as well. All right, come to the end of my presentation, and like Lady Godiva, I must come to my close, as I like to say. I always like to end where I started. Key message for me throughout the presentation has been the importance of recognizing that Social Security is designed to provide you that base of income, that foundation that you can count on being there. But as a base of income protection, you must take steps to supplement, because it was never intended to be anyone's sole source of income in retirement. So you recognize that, work with your Claro advisor to find ways to move from what Social Security provides to where you need and want to be for that comfortable retirement, and the more likely you are to enjoy that comfortable retirement. So again, hope the information is helpful. Happy to open it up and take any questions that any of you may have.
I don't see any questions coming in.
Anyone? Bueller? Anyone? 1490. Anyone? Two? Christopher? Anyone? Columbus? This is just a little humorous interlude.
Let's see. Here we go. Here's a couple questions. These are technical questions. Is there a link to log in to Social Security?
Yep. And so basically, again, and now you guys got to post the PowerPoint somewhere on the Claro website or something like this, because I'm happy for people to have a copy of the PowerPoints. But if you go back, you establish your Social Security individual account by going to www.socialsecurity.gov/my-account, all one word, MYACCOUNT. And that's the link you go to set up your account in the first place. And then once you set up your account, you go to that link, and that's how you access your Social Security account. But on maybe the third slide, it does show that link that you use to set up and then access your Social Security account.
Yes, and we apologize. I know the beginning slides weren't flipping forward, so we will be sure to send that around. Here's a question.
People saying Social Security would be bankrupt, true or false? I get this question all the time, and I always like to answer it by referring to Mark Twain, who once said, "Reports of my demise are greatly exaggerated." I think reports of Social Security's demise are greatly exaggerated as well. You need to understand each year Social Security's Board of Trustees issues a financial report on the health of the system, not only laying out the current status, but attempting to project 75 years into the future. 2019 report came out in April, and basically trustees project it's currently constituted, assuming no changes to the program whatsoever, no increase in taxes, no cuts in benefits, absolute maintenance of status quo. They project that Social Security has enough money on hand to cover 100% of promised benefits each and every month between now and the end of the year 2034. And in the report, the trustees then go on to say, which a lot of people conveniently overlook, It's not like Social Security is not going to have any money whatsoever. They project that in the year 2035, absent any changes, Social Security is projected to have enough money to cover 79% of the benefits from us going forward. That's an important point for younger folks who talk to me all the time and say, well, there's not going to be anything there for me. Understand that Social Security's primary source of income, payroll tax dollars collected from employers, employees, and people who are self-employed. So absent a complete and total collapse of the United States economy, so that nobody anywhere is working, Social Security is always going to have a revenue stream of some sort. And the issue looking down the road is, again, absent changes to the program, is that revenue stream thought to be enough to cover all of the benefits that have been promised? And between now and the end of the year 2034, it is, beginning in 2035, absent some changes, it's only going to be enough to cover 79% of the benefits promised. So the issue confronting Congress in dealing with Social Security is not how do you cover or close 100% funding by tomorrow. No, it's how by the end of the year 2034 do you close this 21% funding gap. And I think there's lots of things that Congress can do. Thinking about it, Social Security, it's basically money coming in, it's money going out. And so the situation confronting Congress and the American public about Social Security isn't really any different from your own situation at home. If at the end of the month you don't have enough money to pay all your bills, you either have to bring more money in or pay a little bit less money out. I think that's the same way with Social Security. You can close that 21% gap simply by bringing in more money. Well, if you do that, who are you impacting? Well, employers, younger folks. You close the gap simply by cutting 21% in benefits, who are you impacting? Old people like me. So at the end of the day, you'll see Congress dealing with the issue, closing that gap, a combination of some income increases, some slowdowns on the outflow side, so COVID feels getting single enough for treatment. But in many ways, Social Security is hurt by the fact it doesn't face an immediate crisis. These days, Congress kind of lurches from crisis to crisis. And because there's no danger in benefits not being paid this month or next month, it's very easy for Congress to sit back and kind of leave the problem for somebody else to deal with. You should deal with it sooner rather than later, but don't fall into the trap of thinking the program crisis or it's going bankrupt. Social Security faces some challenges down the road, and I think it's not what Congress will deal with those because it's too successful a program to let go belly up. One last question: how many workers do we have contributing per person collecting Social Security? Right now, it's about 2.8 people paying in the system for each one person collecting. The problem is beginning in the year 2035 and continuing drops down to 2 to 1. If somehow we can get the worker to beneficiary ratio back up to 3 to 1, trustees project we wouldn't have any problems in the future of Social Security. But it's, people are living longer, collecting longer. People aren't having many kids as they did, baby boomers, things like that. So right now, 2.8 to 1, projected to drop to 2 to 1. Get that back up. Social Security won't face any problems whatsoever. So Ryan, 2 more kids.
All right.
Thank you very much, Kurt. That was very impactful. Thank you to everyone who dialed in and took some time out of their busy days to learn a little bit more about Social Security. Kurt, like I said, is the expert, and that resource doesn't stop here. So if you've got an additional question, please email your financial advisor here at Claro, and we'll make sure that question gets answered promptly. As always, we appreciate your continued support of our business, and thank you for joining us this afternoon. Thanks again to you, Kurt, as well. Bye-bye.